For most of the country, the Houston housing market still feels unstable. National headlines continue to talk about sluggish home sales, affordability pressures, mortgage rate volatility, and stalled momentum compared to the pandemic boom years. But in Houston, something quieter, and arguably more important, is happening. Instead of collapsing, instead of overheating, instead of freezing, Houston appears to be normalizing. And that word, normalization, may be the most misunderstood concept in housing right now. Because after years of extreme volatility, many people have forgotten what a normal market even looks like. Between 2020 and 2022, housing across the United States entered one of the most aggressive growth cycles in modern history. Mortgage rates fell to historic lows. Demand surged. Inventory collapsed. Bidding wars became common. Homes sold in days, sometimes hours. Prices accelerated at double-digit rates. That period felt unstoppable, but it was never sustainable. Now, as we move deeper into 2026, Houston's housing data suggests a return to something much more stable, something that resembles 2018 or 2019 far more than 2021. The question is that stabilization a warning sign, or is it a sign of long-term health? In this video, we're going to break down what the Houston Association of Realtors MLS data actually shows, why headlines describe the market as slowing, how Houston compares to the broader U.S. housing market, whether buyers now have leverage, what sellers need to understand in 2026, and what realistic risk factors look like going forward. This is not hype. This is not fear. This is not speculation. This is the data and what it actually suggests. Let's start with the foundation. The Houston Association of Realtors, commonly referred to as HAR, provides MLS data that tracks actual transactions, not opinions, not forecasts, but real sales activity across the Houston metro area. And when we examine recent reports, a very specific pattern appears. Single-family home sales volumes are hovering near 2019 levels. That's important, because 2019 was the last full pre-pandemic year, before record-low mortgage rates distorted demand patterns. During the pandemic surge, Houston saw elevated sales volume combined with rapid price growth. But those conditions were artificial in many ways. Ultra-low borrowing costs temporarily boosted purchasing power. Stimulus liquidity increased buyer confidence. Remote work trends accelerated relocation patterns. Inventory shortages intensified competition. When rates began rising in 2022 and 2023, transaction volume slowed, not just in Houston but nationally. Now in 2025 and heading into 2026, Houston's transaction levels are not collapsing. They are normalizing. Sales are occurring at a pace consistent with pre-pandemic conditions. That shift can feel like weakness compared to 2021. But compared to historical averages, it looks balanced. Price growth has also flattened, not sharply declining, not aggressively climbing. Flattened. That suggests supply and demand are approaching equilibrium. Pending sales, a forward-looking indicator, have shown moderate stabilization as well. That means buyers have not disappeared. They are simply operating differently. Instead of rushing, they are evaluating. Instead of bidding aggressively, they are negotiating. Instead of fearing they will miss out, they are comparing options. That behavioral change matters just as much as the numbers, because housing markets are psychological as much as they are financial. If Houston is normalizing, why do headlines describe the market as slowing? Because perspective matters. During the peak of the housing boom, homes were selling at extraordinary speed. In some neighborhoods, properties would list on Thursday and go under contract by Sunday. That kind of velocity creates a new mental baseline for what feels normal. So when days on market rise from 5 days to 30 days, it feels dramatic. But historically, 30 days on market is not a crisis. It is ordinary. The Houston Chronicle has reported that homes are sitting longer compared to the frenzy years. Inventory has increased. Buyers are taking more time. Price reductions are appearing more frequently. But those are symptoms of normalization, not necessarily distress. Let's think about inventory. During the pandemic boom, inventory in many markets dropped to extreme lows. Months of supply reached levels under 2 months in some periods. That creates upward price pressure because buyers compete aggressively for limited listings. Now, inventory has expanded. Buyers have options. Options reduce urgency. Reduced urgency increases days on market. Increased days on market reduces bidding wars. Reduced bidding wars stabilizes price growth. That is how markets rebalance. What feels like slowdown compared to chaos may actually be structural health returning. To fully understand Houston, we need to compare it to the national housing market. Across the United States, existing home sales remain below 2019 levels. High mortgage rates have locked many homeowners into sub-3% loans from 2020 and 2021. That lock-in effect reduces inventory nationally because owners are reluctant to sell and lose their low rate. Houston differs in several ways. First, Houston historically has more flexible land use compared to many coastal metros. Second, home prices in Houston remain lower than in markets like Los Angeles, San Francisco, New York, or Miami. That relative affordability acts as a shock absorber. When mortgage rates rise, affordability declines everywhere. But markets with lower baseline prices often maintain stronger demand resilience. Houston Agent Magazine recently highlighted that Houston has largely returned to pre-pandemic transaction levels, while much of the U.S. market still struggles to reach 2019 volume. That divergence suggests Houston may have corrected faster, and markets that correct faster often stabilize faster. We're going deeper now. Inventory structure, affordability math, submarket behavior, psychology shifts, and realistic 2026 risk scenarios. If there is one variable quietly reshaping Houston's housing market right now, it's inventory. During the peak pandemic years, Houston, like much of the country, experienced historically low housing supply. Listings were absorbed almost immediately. Months of supply compressed. Buyers competed aggressively. Low supply creates upward pressure on prices because scarcity amplifies urgency. But inventory today looks very different than it did in 2021. Listings have increased, active supply has expanded, homes are remaining on the market longer. This does not mean Houston is flooded with excess homes. It means supply has moved closer to equilibrium. A healthy housing market typically operates around 4 to 6 months of supply. Below that range favors sellers. Above that range favors buyers. Houston appears to be moving closer to balanced territory. And balance is important, because extreme sellers' markets can inflate prices beyond sustainable levels. Extreme buyers' markets can trigger price corrections. Balanced markets stabilize appreciation. And stable appreciation is healthier for long-term growth. Now here's something important to understand. Inventory growth does not automatically equal price decline. Inventory growth simply reduces competitive intensity. Prices typically decline sharply only when supply significantly exceeds demand. Right now, Houston's supply expansion appears measured, not explosive. That's a key distinction. Let's talk about affordability in practical terms. Mortgage rates today remain elevated compared to 2020 lows. Even if rates are in the mid-6% range, that is more than double the ultra-low pandemic rates. What does that mean for buyers? Let's use a simplified example. If a home costs $350,000, at a 3% mortgage rate, the monthly principal and interest payment might be roughly $1,475. At a 6.5% mortgage rate, that same loan could push monthly principal and interest closer to $2,200. That difference dramatically affects purchasing power. Now combine that with flat price growth instead of rapid appreciation. Buyers are no longer racing to beat next month's price surge. Instead, they are calculating monthly payment sustainability. That changes behavior. Houston's relative affordability compared to coastal metros helps cushion that impact. A buyer choosing between a $350,000 Houston home and an $850,000 coastal property faces dramatically different affordability math. That relative value keeps Houston competitive nationally. But affordability remains tighter than pre-2020 conditions. which means demand is selective, not aggressive. One mistake many people make when analyzing housing markets is assuming uniform behavior across an entire metro area. Houston is not one single market. It is dozens of submarkets operating simultaneously. Entry-level homes under certain price points may still move quickly if priced correctly. Mid-tier homes may require negotiation and slight price adjustments. Luxury homes above higher thresholds often experience longer marketing times because buyer pools shrink as price increases. That layered behavior can create confusing headlines. One neighborhood may show price strength. Another may show mild softness. The broader metro may look stable overall, but internally, different segments are adjusting at different speeds. That's normal. When markets transition from aggressive growth to normalization, higher price tiers typically feel it first. Why? Because higher-end buyers are more rate-sensitive and more discretionary. Entry-level buyers, especially first-time buyers, often remain active because housing is a necessity, not just an investment. So when you hear the market is slowing, the real question becomes, which segment? Which neighborhood? Which price tier? Houston's diversity makes it more resilient overall, but more complex internally. Beyond numbers, housing markets move based on psychology. During the pandemic surge, fear of missing out dominated buyer behavior. People believed prices would continue rising rapidly. Waiting felt risky. Today, that fear has diminished. Buyers are not panicking. They are negotiating. They are asking for concessions. They are comparing listings. They are waiting for price adjustments. That shift in mindset changes everything, because when urgency fades, discipline returns. And disciplined buyers create stable markets. The absence of panic does not equal absence of demand. It equals measured demand. That is what Houston appears to be experiencing. Now let's talk about real risk scenarios. There are several factors that could shift Houston's trajectory. First, mortgage rate volatility. If rates unexpectedly spike higher again, affordability would compress further and demand could slow more noticeably. Second, national economic weakness. Houston has a diversified economy, but it is not isolated from national conditions. A significant recession could impact buyer confidence and employment stability. Third, overexpansion of inventory. If listings increase faster than buyer demand grows, localized price pressure could emerge. However, there is currently no strong evidence of runaway oversupply. The data suggests moderation, not excess. Fourth, energy sector fluctuations. Houston's economy maintains ties to energy markets. Major disruptions in that sector could influence local housing demand. But again, diversification has improved compared to prior decades. Normalization does not generate dramatic headlines. Booms and crashes dominate media cycles. Balance does not. But balanced markets often produce sustainable long-term appreciation. When prices grow at modest rates, not double digits, housing becomes more predictable. Predictability supports responsible lending. Responsible lending reduces systemic risk. Reduced systemic risk lowers crash probability. In other words, Houston's current trajectory may not excite speculators, but it may encourage long-term stability. That may be the real story of 2026. Let's finish this strong. If you're a buyer entering the Houston market in 2026, the environment you're walking into is fundamentally different from 2021. You are not competing in widespread bidding wars. You are not forced to waive inspections in many cases. You are not racing against dozens of offers on every listing. Instead, you're entering a market where negotiation has returned. That does not mean every property is discounted, but it does mean pricing strategy matters again. Buyers in 2026 need to think in terms of payment sustainability, not short-term appreciation speculation. With mortgage rates still elevated compared to pandemic lows, monthly payment comfort becomes the core decision variable. The smarter buyer approach in this environment includes comparing multiple listings before committing, watching days on market for leverage, negotiating seller concessions when possible, being patient rather than reactive. Patience is a strategic advantage in balanced markets. During boom cycles, speed wins. During normalization cycles, discipline wins. And Houston right now rewards discipline. For sellers, 2026 is about realism. During the housing surge, the market often forgave overpricing. You could list high and rely on demand momentum to correct your pricing mistake. That safety net is gone. Pricing accurately from the beginning matters more than ever. Overpriced homes sit. Sitting homes require reductions. Reductions signal weakness. Weakness reduces negotiation power. Sellers must now compete, not just list. That means proper staging, strategic pricing, realistic expectation setting, understanding submarket trends. Houston is not collapsing, but it is selective. And selective markets require sellers to adapt. Homes that are priced correctly and presented well are still selling. Homes that are priced emotionally instead of strategically are not. That's a major psychological shift. For investors, the 2021 mindset no longer applies. Speculative appreciation, buying solely because prices are rising quickly, is far less reliable in a stabilized environment. Instead, investors must focus on fundamentals: cash flow, rent stability, long-term population growth, local employment trends. Houston continues to benefit from population inflows, business relocation trends, economic diversification, relative affordability. Those structural drivers support long-term housing demand. But investors in 2026 must underwrite conservatively. Assume moderate appreciation. Stress test for vacancy. Account for higher financing costs. Houston may still offer opportunity. But the easy money phase appears to be over. And that's not negative. It's mature. Let's walk through realistic scenarios for the next 12 to 24 months. Mortgage rates remain in a predictable range. Inventory grows gradually but not excessively. Employment remains steady. In this scenario, Houston likely experiences modest price growth in certain segments and flat pricing in others. Transaction volume remains near 2019 norms. This is the most probable baseline case based on current data. If mortgage rates spike significantly higher again, buyer affordability could compress further. Demand would likely slow. Days on market would rise. Price reductions could increase in select submarkets. However, absent forced selling pressure, dramatic price collapse would remain unlikely. If broader economic conditions deteriorate meaningfully, confidence drops. Housing markets typically respond to employment trends. In this case, Houston could experience localized softness, especially in discretionary price tiers. But Houston's diversified economy provides some insulation. Looking beyond 2026, we need to focus on structural forces rather than short-term volatility. Houston benefits from land availability, infrastructure expansion, energy sector stability, healthcare growth, logistics and port strength, population migration trends. Long-term housing performance is often tied to job growth and wage growth. If Houston continues expanding economically, housing demand remains supported. The key difference between now and 2021 is velocity. Growth may continue, but at sustainable rates. Sustainable growth compounds more effectively over 5 years than volatile spikes followed by corrections. Normalization today may actually be laying the groundwork for healthier long-term appreciation. It's easy to mistake deceleration for danger, but housing markets cannot expand at double-digit rates forever. When acceleration slows, balance returns. Houston's housing market in 2026 appears less dramatic, but more stable, less chaotic, but more predictable. And predictability is powerful, because predictability allows buyers to plan. It allows sellers to strategize. It allows investors to underwrite responsibly. The absence of frenzy is not weakness. It is maturity. And mature markets tend to endure. The loudest narratives in real estate tend to revolve around boom or bust. Houston's story right now is neither. It is transition, from volatility to balance, from urgency to discipline, from speculation to fundamentals. Sales volumes near 2019 levels. Inventory trending toward equilibrium. Price growth flattening. Buyer leverage returning. Those are not crash signals. They are normalization signals. And normalization may be the healthiest phase Houston has entered in years. Extended YouTube outro, retention and engagement. If you made it this far, you now understand something most headline readers don't. Houston isn't exploding. Houston isn't collapsing. Houston is stabilizing. And stabilization is often the turning point between chaos and sustainable growth. If you found this breakdown valuable, hit the like button so more people can see data-driven housing analysis instead of speculation. Subscribe to the channel for continued updates on Houston and national housing trends as 2026 unfolds. Tap the notification bell so you don't miss the next market breakdown. And drop a comment below. Do you believe Houston is entering a long-term stability phase? Or do you think a bigger shift is still ahead? Your feedback helps shape the next analysis. Thank you for watching, and I'll see you in the next video.